Hey, thanks for joining our live broadcast today about FBAR updates. I'm joined by Anthony Parent, one of the founding partners of Parent & Parent, IRSMedic, the nation's #1 disclosure firm.
That's right.
Yes. It's our intention to help people sort of, muddle through the shark-infested waters of offshore reporting and dealing with the IRS. Really about educating people on what's going on. And we got a great comment on a FATCA video we did today. He said, living in Bolivia, this info is like inventing fire. My thanks. And that really makes me smile because that's our intention, is just to help people try to get through all this. So today we do want to talk about important FBAR updates for July 2016. We'll start with Form 114 FBAR instructions. Now, you have to e-file.
That's correct.
That's pretty new.
Right.
We did a really great video. Anthony did step-by-step instructions on exactly how to do this e-filing. We've seen people out there that have pretty similar guides and they're charging for it. Ours is free.
That's right.
So just search our YouTube channel and you'll see it's got tons of views on there, so helping lots of people. Now, Anthony, talk to me about the new FBAR deadlines.
Okay, so June 30th, 2016 was the last June 30th deadline for an FBAR. That was the deadline of your 2015 FBAR.
Okay.
So from now on, your FBARs are going to be due when your individual tax return is due. So you're looking at April 15th, June, if you live in the U.S. and no extension, June 15th if you are an expat and no extension, October 15th, whether you're and you file an extension, whether you're an expat or living in the U.S., and then December 15th if you get that permissive extension if you are an expat.
Okay. And we're saying now with this June 30th deadline, I mean, we're here July 18th or so. If you haven't filed, probably a good idea just to file it even if you're late.
Right. There's no such thing as late FBAR penalties.
Okay.
There's late tax filing penalties, but there's no late FBAR penalty. There's just non-filing penalties. So I haven't heard, if filing your 2015 FBAR sometime in 2016, it's very unlikely they would ever assess late FBAR penalties. And the only way to do it really is to assign an auditor to do that. Whereas if you file a late tax return, the processing system will automatically assess those late filing systems. So don't let the fear of a late filing penalty dissuade you from filing it now if you haven't.
Okay, and let's talk about FBAR audits. People are very concerned about getting audited for their FBAR. We have some penalty updates, who it's affecting, who it's not. So tell me about that.
Well, some things that have been going, some trends that we've been seeing is that there's 2 units at the IRS that have been auditing FBARs, the Self-Employment Small Business Unit and the Large Business and International. So, the Large Business and International is really sort of the bigger, more sophisticated arm of the IRS than small business self-employed. They've been getting into the game a little bit more.
Okay.
They have been doing them, but from what we see is that there's more LB&I. And that would tie into something that we did see from the Treasury Inspector General report on the Offshore Voluntary Disclosure Program. They claimed that the IRS had too many high-end agents working offshore disclosure cases where people are coming clean, and that they should utilize those resources somewhere else. And so perhaps, potentially, the higher grade, your 13s, your grade level 13s and 12s, more to go to FBAR audits as opposed to working disclosures where somebody has already come clean.
Yep.
So that's something that seems like it is happening right now.
Now, what we try to stress with people is that they're not specifically auditing FBARs. They're doing audits on other things, and then the FBAR arises.
That's right.
So what are some things that are triggering the audits?
This is what seems to be doing it. There's actually FATCA. Even though that was a law passed in 2010, it seems to be triggering audits at a greater rate than the FBAR, even though that was part of law in 1970. And this is the reason why, as we're sort of tracing together various things from new clients, things that we've been seeing come up. And these are older accounts. So what has happened, it looks like these older accounts older accounts were in foreign jurisdictions, and those foreign jurisdictions have these banks who want to comply with FATCA. And FATCA requires the banks to do a due diligence to see if they have any U.S. persons associated with this account and make sure that they file a W-9 and are fine with their information being disclosed to the IRS. Now, in order for all of that to happen, that bank needs to send a letter to that U.S. account holder, say, hey, we think you're a U.S. person. Fill out this W-9. If you don't, we're going to disclose you to the IRS. Well, what happens if you close that bank account in 2008? What happens if you changed addresses? And you can imagine that maybe you opened the account with your U.S. address, or maybe you opened it with an overseas address, and you could be at any one.
And the IRS has said, hey, we have a really hard time sending our stuff overseas.
Right.
You probably won't get it.
Right. So there's such a substantial risk that you actually don't get the notice, this FATCA letter. In 2014 and 2015, when the FATCA letters really started coming out, there were so many people calling us with the, oh my, I have a huge problem, I can't believe it. Those calls have started to go down, but we know, looking at the amount of people who, the amount of people living overseas, the amount of people with offshore accounts versus the amount of people who've made disclosures, the numbers aren't adding up. And so, and then also some people might have given a fake address when they opened up. So that these FATCA letters are going out and the banks are getting no response. So they just said, oh, we didn't get a response. Here they are. They didn't respond to us. And so those names are now going to the IRS for audit. So it's really now the IRS will suspect there's an FBAR penalty too, but that's not really what's triggering it. It's coming through FATCA, which is really Title 26 of the U.S. Code.
So an example we had literally within the past month was somebody who had an offshore credit card, the Icelandic bank. It had been closed for, he said, probably a good 10 years. But just having that, he's like, it was like a prepaid credit card too. So offshore credit cards, unfiled returns obviously are going to trigger audits.
That's what we're seeing too. These unfiled returns, that seems to be based on what we were seeing. The IRS has to prioritize their resources. And so what it looks like they're going for first, okay, did we get a FATCA letter on the person? Are they unfiled? Okay, those are the people we're going to go to first.
It's a pretty easy target.
And, right, you didn't file. Now, this is what we know is the IRS has a lot of names, and they have to sort of go through how they're going to process them. Where they're running up on statute of limitations, those are the ones they want to get to first. And one of the IRS examiners told us something. They told us to Robert Hansen, our lead OVDP attorney. They said this, and it was sort of frightening. They said, we have everyone at UBS. We have all the names. And so I asked Robert, what do they mean? Did they have all the 4,440 names originally required of the 2009 deal? And Robert's thinking, I don't think that's what they meant, because there was about 45,000 U.S. account holders. What I think they meant is they had all 45,000 account holders. And we know that there were not 45,000 disclosures of UBS. And there's a lot of people still who haven't come clean. And most of those, again, are going to be people who didn't get that original FATCA letter, who maybe didn't know they had to do this. And so they're walking around not aware that they're really in the targets next. And again, the IRS is just trying to figure out who to go after first. One of the things that the IRS has in their card now, which is they didn't have in 2009, was that they can do a 6-year audit review by proving a substantial underreporting. Now, the substantial underreporting...
Substantial.
Right. We used to be pretty high. Now it's 25% of unreported income, and that allows them to go and assess all these years. Also, with FBARs, you have a 6-year statute of limitations. So the only year that has passed so far is 2009.
Yep.
Okay. But then there's also those other foreign, the foreign reporting requirement forms, such as our Form 5471. We did a nice big article on that. That is for foreign corporations, foreign partnerships, foreign trusts. Switzerland's huge in foundations. That's where a lot of foundations. And something the IRS has known since at least 2009, because this is when they told me about it, that more than 50% of all Swiss bank accounts were held in the name of entities. So while you think, hey, look, I got away with my 2009 FBAR, I don't have to worry about it, the statute is passed, they still have these other things open. And that if you don't file a Form 5471 and all these other informational returns, your 8858, 8621, the 3520, 3520A, the IRS has forever to assess those taxes. And so they could really put you on the back burner. They could say, well, we don't need to get to this person because we can get to them much later down the road. And really what they're, in what their hope is, and I think why I would want to put those people on the back is as you're getting to people where statutes are going to expire, those people might tell you something about those people. So now you have it because our number one thing, and I have this as one of the updates, the number one source of bad information about FBAR penalties comes from the taxpayers themselves. They don't know what they're saying, and they say something that basically gives the farm away to the IRS. So that's where taxpayers are not helping themselves.
Yes.
They're going into it and they don't know the importance of the particular words they use.
I was just going to say a tax attorney is just so important because what we've been now seeing, now the program's been going for a while, is we've got clients coming to us that hired either a different resolution place or a lawyer that's not tax specific.
Yep.
And you really need to understand these laws.
Or a lawyer who is tax specific but just dabbles in the offshore disclosure and doesn't understand just the rules of the game. And, we've been with it from the beginning. And so we've seen the evolution of everything change. And
willful versus non-willful is you want to make sure you have someone that can represent you to say you're non-willful.
Exactly. And that can make a huge difference. But I would say this, too. We've taken over some OVDP opt-outs or where the person gets the Form 906 and, they kind of knew the penalty was going to come, but now they're looking at the penalties with the taxes and the interest, and now they're thinking, this doesn't seem right. This is going to wipe me out. This is, my life savings you're talking about, and you're going to take more than 50%. And especially if the mark, your portfolio, like many people, its high balance was in 2008, 2009. You don't have that money anymore, but yet you're penalized on what the high value used to be, and so for a lot of people, they're getting wiped out. And for a lot of people, that they're needing to file offers and compromise because they can't afford to pay it.
That's interesting to know. You can use an offer and compromise with the penalties associated
with
for FBARs?
Not for FBARs.
Oh, okay.
Because that's a Title 31, so that's a totally separate thing.
Yep.
But with your income taxes, you can use an FBAR. One thing I would say is you want to make sure, because we've had cases where somebody's considering, well, my attorney told me I didn't stand a chance in an opt-out. I better do this because there was no chance. Well, a lot of attorneys don't want to stick their neck out. FBAR opt-outs are not for everybody. We've had very good success with them. And one way to have success is sort of know what the outcome is going to be in the first place. And we've run into those cases where someone's looking at a 50% FBAR penalty, 27.5 FBAR penalty. Now you have to remember that FBAR penalty base will include things like foreign commercial real estate. So that could be rather substantial, even though the FBAR doesn't require that to be reported. So it's kind of crazy. Like, wait, you're looking for a penalty because I didn't file this thing, but your penalties you're looking to get are things that don't have to be filed on this. So when you look at that and when you remove things that don't belong in the actual FBAR penalty base, and when you look at what's really unfiled and you're looking at limits, you go to your mitigation guidelines. Because we had we're working one case right now where it was like, well, you're better off with the mitigation guidelines to opt out, because even if you lose and get a willful penalty, you're still far ahead of the game. And then we're still going, we're going for a non-willful. So, hey, look, we really might hit a home run, or we'll do better.
Right.
So that's something you really want to look at, and also don't expect, this is a common theme. This FBAR stuff is new to the IRS. Okay, and these guys have a lot of work to do. There's so many changes, just tax code changes, and now they have to deal with something that's not even part of the tax code. FBAR is not a part of the tax code. And so just as if you were working this case, if you were assigned an FBAR case and you're wondering what to do, and there's this whole big book over there that you could go reference. Or you
could go, hey, Bob, what would you do in this case?
Right, and that's what you find. Yeah. It's basically they're getting information from each other because they're overwhelmed and they're scared. People look to see what other people are doing. That's the first thing you do to say, hey, am I doing the right thing? You look around and say, oh, okay, we know that's true. That's just human nature. And so that's what they're doing too. So you'll see them come back with something that isn't quite right.
I love Attorney Hansen. He was saying that he has conversations sometimes with them, and he says, well, can you please where are you getting this information? Tell me exactly
Yeah.
where I can find this information. And they can't tell them.
Right.
They don't know.
That's just the way it
where's
is.
What's
Right.
your source? They don't know what their source is.
Right. So using the Internal Revenue Manual can be it can be an incredibly powerful source because they will get mitigation guidelines wrong. We've seen that on non-willful. We've seen that on willful, or they might not just be aware of it.
Okay.
That they didn't know. And so it's really your job to point out and make sure, look, there's a lot of things that people give up too easily. They didn't fight. They didn't actually look at what's there. And so that's where we spend a lot of our time on. And we try to educate them in a very nice way.
Yes, we've stressed before, when you deal with the IRS, you don't want to ruffle any feathers. You don't want to create any crazy waters because they'll just put the spotlight on you even more.
Right. And if you're looking like a bully to one of the IRS examiners and you're trying to just intimidate them, that's fine and may work against that employee. But look, they have some talent on their side. And you could imagine an IRS attorney looking at this case to say, this other attorney thought he was hot stuff here, huh? I'll show you a thing or two. And now you've really created a battle of somebody who has far more resources than you did. So that's really not the way you want to handle it. You want to just, be nice, be polite. And when you push back, just mention what the facts are. We've seen them trying to extend statute of limitations that already expired. With there's a lot of things we've seen where they're doing their best to try to understand far too much than any people should be required to know as part of their job. If you were, the average person could not handle this. No. And even the above average person, it's not a job for them. You have to be a rather exceptional person to be able to handle these exams. And they're really some talented people, but that doesn't mean they have to take shortcuts at some point.
Okay. Any other updates?
I would say just make sure. The one more thing is the auditors, and this sort of ties into everything else we have to say. There are two general states of mind with FBAR. Mm-hmm. Non-willful and willful. Okay. Now, in law school, we spend a lot of time talking about what a state of mind is and how that leads to your culpability or liability. And I would just say this, and I'm sure there's some people that disagree, but generally we have four standards of behavior when we're trying to assess penalties. Okay, so I'm going to run through them, starting with the least amount of culpability. Strict liability is, did you do it or not? We don't care what's on your mind. That's sort of like speeding. Mm-hmm. Hey, you know what? You were going 65. I don't care what your excuse is. The law says you were going over the speed limit, and we have no way to really prove whether you intended or not. So strict liability is you're going to be you did it. That's it. You're guilty. Okay. Now with strict liability, on the other hand, is you can't have the penalties too high because you have no idea what they were doing. Next comes negligence. Negligence, there's various ways to define it. But probably the best way I heard was described for a bar exam review to say, is the result fair? Just like think of fairness when you hear of negligence. Someone was driving, didn't see a cyclist, didn't intend to do it, didn't see him, ran him over. Mm-hmm. Okay, that person, it's something more than you got to be somewhat responsible. You had control over, whether or not you should have kept a better lookout, is what they always say in the pleadings. Mm-hmm. But you didn't intend to do it, and you weren't doing anything crazy. You were doing something, hey, any one of us could have done it. Right? Okay. So that's negligence. And then you have recklessness. And recklessness is always, my best example is going through a main street of a town at 120 miles an hour. Okay? Now, you might not be intending to run anybody over, but boy, the likelihood of running somebody over is pretty high. So if you do run somebody over, maybe they'll get a push for, hey, depraved heart, intent. That it makes it a specific intent, but more likely they have a recklessness. Okay. Come on, this is just basically a foregone conclusion, the fact of something bad happening. Now, the fourth one you have is a specific intent. That is, you did it. You meant to do it, and you did it. So what we have is, in the scope of things, is that we have the IRS is trying to, and these examiners are trying to shoehorn people's behavior into one of the four, but really only two of them are operative. Mm-hmm. Strict liability is one. That's like you didn't file your FBAR, period. Now, you may bring a reasonable cause to say why you didn't, but it doesn't matter. Non-willful, you didn't file. They can really get you on that. Now, it's your burden to prove you had reasonable cause to do that. Okay. And then the other one is not you were willful. Well, that's specific intent. So you see the whole scope of things. We're at the extremes of state of mind with how they've written the law. So you have this whole area in here where examiners are trying to figure out where people fit. And sometimes they'll take somebody, well, you are negligent. And so that negligence, I'm going to say, is kind of willful, which we're saying, whoa.
But I didn't even know I had a filing requirement.
Right. It's like, well, that's a little too much. And then also the willful blindness is one where they try to use as a catch-all to say, well, yeah, sure, you didn't know about it, but you should have known about it. So that's really where a lot of this comes into is, us as attorneys approaching it. We approach it differently from the IRS, but we need to know why they're doing it that way. And we try to explain to them why that's not going to work out. And when you deal with FBAR appeals, the FBAR appeal officer is going to understand, yes, this is going to go to court. And so those standards that we're talking about will apply. Hopefully we can avoid all of that and avoid going to appeals because appeals will, they're going to look to uphold the IRS. Hopefully you can overcome that.
Yep. Yeah, we like to tell the whole story. All right. Well, thanks again for joining us. You can search our YouTube channel for other great FBAR updates. Also go to IRSMedic.com and you can search our blog by keyword FBAR. Also some great FATCA information on there. You can like and comment below. You can subscribe to our channel for other updates on upcoming live events. Again, thanks for joining us here at IRSMedic. IRSMedic, the law offices of Parent & Parent, LLP. Real tax attorneys for tough tax problems.